The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and we're going to talk about taxes. And if you have any questions or you haven't filed your taxes because the extension deadline is looming here in just a few 15, 16 days, we want to help you. Our phone number here in studio is 8030930, 8030930, star 930 on a cell phone. And our text board is up this week. Our text board is 716-8030930. We'd love to help you with any of your tax issues. And we're going to talk about taxes for seniors today specifically and retirement. But I got Tiffany Fabian in studio with me. Hey, Tiff.
Hey, happy Saturday.
Happy Saturday to you and your buddy, Christopher Fabian.
Hello, Esther.
Hello, Christopher. Okay, so, and again, 8030930, 8030930, star 930, and a cell phone, 716-8030930. Our school started, right?
Yep, it did on
Thursday.
Yep, I was going to say that. I thought I was stepping on you. And it's really exciting. We have the largest class we've had in years and years and years. So and we have a new training center. And so we're really excited. We have smart boards that we're using. And it's a great opportunity to learn taxes from A to Z. And you're going to learn and hopefully work for us. And it's a great opportunity. And we're so thankful for everybody who joined.
Yep, that's true. We have like 120 students in basic class, right?
Yep.
And our advanced classes have like 100 people in. So we, this time of year, people say, what the heck do you do? Well, this is part of what we do. We're getting ready for tax year 2023. That's what we're doing.
Right, exactly. And getting other people ready for 2023. We're doing our consultations and tax
let's
planning.
talk about Ready, Set, Retire, because that's why I wanted to talk today about retirement and retirement planning, because if you're planning on living and not dying and you're going to make it to retirement, what we're going to talk about today is really important. And that's why we're offering a free seminar that we've been doing for several years, and we're doing it in connection with the financial guys, right?
Correct. This is going to be held on 11/11 at their building on Spindrift. It's it's same type as how we've had it in the past. You get to meet everybody, and then you have 15-minute breakout sessions with who you want to talk to get your ducks in a row or start getting them in a row. Lawyers and financial planners and Social Security and Medicare and taxes and you name it.
And health insurance, right?
Yep.
So it's really a great opportunity at no cost to you, no pressure. It's really, if you've gone to the Taste of Buffalo, this is like a taste of retirement. And how would they register, Chris?
Well, they can go to our website, egtax.com. There's a link, or thefinancialguys.com. There's a link there. You can even give us a call at our office, and we'll get you registered over the phone. Right. So a lot of different ways, a lot of things. The only thing you said, a taste of retirement, the only thing we can't guarantee is sunshine on the beach.
That's true.
And our office phone
whenever
number,
you're in Buffalo, you can't ever guarantee sunshine.
Yeah,
right?
And our office phone number, if you want to call to register that way, is 632-7886.
Right. Okay. So we're going to talk today about retirement planning, but I got Larry that just called, so we're going to talk to Larry first. Hey, Larry, how can we help you?
Yeah, I have a couple of questions. The first one has to do with withholding amounts to avoid a penalty on your income tax.
Uh-huh.
Now, let's see if I got this right. For the federal, you need to have the money you owed from the previous year. Like, say, I owed $1,000. If I have $1,000 deducted this year, I wouldn't get any penalty if I owed money. Is that true?
Almost right. It's your tax bill from last year. So it's
your tax liability.
It's your tax liability or bill.
Before withholdings.
Right. So if your actual taxes were $8,000 and you had $9,000 in withholding, you'd get a $1,000 refund. But your tax liability was the $8,000. So this year, to not have a penalty, you had to have 90% of last year. You either have to have 90% of this year's liability or 100% of last year's liability paid in to avoid the penalty.
Okay, so if I had $1,000, if I owed $1,000 last year.
No, what's your liability? What would your liability be?
Well,
Not what you owed.
If you didn't have any withholding, how much would have you owed them?
That's a good question.
But that's
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 answer.
the answer.
See, it's not your result. It's what your actual taxes were.
Okay, so if I owed like $3,000,
Then you have to have $3,000 paid in this year,
Yeah.
or not
But-
from last year equal, or 90% of this year's
and
liability.
if it was 3,000, that meant you had no withholdings last
Right.
year.
Yeah. And now, how is it with the state? Someone told me it was like you have to have at least $400 deducted from your state tax in order to
The
avoid
same thing goes true to them as well.
Paid in
so 100% of last year's liability or 90% of this year's liability.
Oh, okay. I thought that was the other way. And for since I didn't have any taxes withheld for the state, if I pay with the form IT 2105, I could send
You
that
mean you
in.
want to make estimated payments?
Yeah.
Okay. Well, again, you have to have 100% of last year's liability or 90% of this year's liability, but they want it in equal installments. So if you haven't paid your estimates properly, in other words, they would have been due April 15, June 15, September 15, and then January the 15th of 2024. If you don't pay them equally, then you would still have a penalty for underpayment for those quarters that you blew off.
The IRS or New York State like their money in equal periodic
Right.
payments throughout the year.
Well, what if I had to pay the full amount before the last tax payment?
Then you're going to get a penalty for the first 3 quarters that you underpaid.
Yeah.
They get you. Don't worry.
Crazy.
Coming and going.
I got another
Yeah, I
one
mean,
on-
they really want you to pay as you earn it. It's a pay-as-you-go plan, and that's where the whole April, June, September, and January of the next year payment plan comes in.
Yeah, because like this, I didn't owe any taxes at all last year in the state.
But again, if it's 100% of last year's liability, if you owe zero, then it's zero.
Last year, if you owed zero.
Right.
So I don't have to
That's
send in
correct.
anything.
Last year was zero, so you could do a form that would make it so that you could avoid the penalty.
Okay,
Yay,
so
good
I don't owe
news.
anything to the state this year.
Okay, then you'll be in good shape.
As far as
I mean, you owe it, but you would have no
I-
penalty.
I didn't owe last year, so I
Right,
wouldn't
so
get a
then
penalty.
you would have no penalty this year
And the
if you
same-
don't make any estimated payments.
And the same thing with the Fed. I got a refund last year. So
No. It's the liability, not the refund. It's the liability. So you actually owed the IRS money, and from that you subtracted the amount that you owed in taxes by your withholding. Don't look at the withholding, only look at the liability. That's what you have to have paid in. On the state of New York, you said you had no liability,
Yeah.
so you don't have any estimated payments that are due.
Okay, so on the federal, then just what I owed from last year, then, right?
Your liability, not your balance
my
due.
liability,
No.
whatever I owed them.
I think you need to call us and we'll walk you through it because I don't want you to misconstrue.
So say out of your wages and your pension last year, you had $2,000 withheld, but your liability was $3,000. So you had a $1,000 refund, but your liability was really $3,000.
3,000, right. That's the number you have to look at.
All right. I got a question on. Can I have another question here for you?
Sure.
I have one on required minimum distribution.
Okay.
If you wanted to donate your required minimum distribution to a charity, they would have to come directly from your 401k or
No,
IRA.
can't be from a 401k. If you wanted to do the qualified charitable deduction, okay, then you have to do a direct transfer from your banking institution or whoever's holding the IRA to the charity, okay? And it can only be from an IRA, not a 401k.
Good question.
And it'll fulfill your RMD requirement.
Yeah. And would I have to declare that amount on my income tax somehow?
No, you just basically put the distribution in, and it's zero taxable because it's a charitable qualified charitable deduction.
And the bonus is it'll make less of your Social Security taxable. And
right.
then
and it's interesting because that's
Medicare.
exactly what I'm going to be talking about. So listen for the rest of the show.
Okay. And I wouldn't have to pay any taxes on the amount that I gave to the charity then, right?
Up to $100,000 from an IRA.
Yeah, well, that won't happen. Could I have your telephone number to call
Sure,
you during the week?
632-7886. Very happy to help you because we don't want you to listen to something the way you think you want to hear it. You know, we want to make sure you understand.
I've done that
It's
many
All right.
632-7886.
886. Okay, Larry. Thanks for calling.
All right,
Right.
thanks for your help.
Go,
Right, thank
go,
you.
Go Bills.
I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We're going to be back on the other side with your questions and comments.
The bills make me wanna shout. Kick your heels up and shout. Throw your hands up and shout. Throw your head back.
Hey, everybody, this is the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Should we worry tomorrow?
A little.
I mean,
little.
70
It's-
points last
Yeah,
week?
it's going to be a good game. But
Oh, my God. I
it's
think I have to
here.
wear Pampers.
It's here in Buffalo, so that's a good thing.
Yeah. I don't know. All these teams I counted on in the past for doing bad, like Detroit, Miami, they seem to be rallying, right?
Yeah.
Okay. Want to talk about,
I know, Detroit
again,
is
80.
amazing.
Pardon me, dear?
Detroit is doing amazing.
I know. I can't believe it. But anyway, when you're a senior, a lot of times seniors will say to me, and I'm sure they say to you guys, what kind of special benefits do seniors get on their tax return? And probably the number one would be the higher standard deduction. Now, the standard deduction this year, if you don't itemize, is $27,700. But if you're a senior filing a joint return, you would get an extra $3,000 if you're both seniors, and your standard deduction would go up to $30,700. Now that means until you have taxable income over $30,700, you pay no taxes.
Right, which
Right?
is wonderful. Very nice. And it
So
has,
now,
and a lot of people
the
get
standard
very,
deduction on the state of New York is not that large, but on the federal this year, if you're making $31,000 taxable, darn near close, you're not going to pay any taxes.
Yeah, and I was going to say a lot of people get really confused. They often call and they're like, so when you don't have to file, it's based on your age. And it's not. It's not based on your age. These are the numbers that you're reading right now. That's what it's based on.
And now if you're single, then the standard deduction this year is $13,850. But if you're 65 or older, it's $15,700. So a single taxpayer would not pay any taxes if their taxable income is over $15,700. So you see there's a lot of money that you can be making and still not pay taxes. So when you hear people talk about putting money into a Roth, that's where you have to really put a pencil and paper to everything to find out if, in fact, you're going to benefit. So let's say, for instance, that you are age 73 and you have to start withdrawing from your pension. You got to do your RMD. And by the way, this year it is 73. You have saved $1 million. You had put $600,000 in, and it grew to $1 million. And now, because of your age, you have to start withdrawing. What's the number here? You have to withdraw.
Divided by 28. Let's see.
No, I got it right here. You'd have to withdraw $36,496. Okay. But over the years, that $600,000 that you'd put in, if it was a traditional 401k, you would have saved $168,000 in taxes. When you put money in a Roth, you save nothing, because at the end it's not taxable. But let's compare. So let's just say that this person had $40,000 in Social Security. They would have, after their standard deduction, they would have a taxable income of $18,044. So their tax bill would be $1,804. So it would take them 93 years of paying $1,804 to offset what they saved in tax savings, $168,000. So that's why a lot of times when we talk about it, a Roth, just because it's not taxable later, doesn't mean that you really won the brass ring on the merry-go-round, right?
Yeah.
Because you have not saved all this money over the years. Now, another way around it, just like this gentleman was talking about before, Larry, about doing a qualified charitable deduction, when it comes time for you to do your RMD out of your IRA, you can do a direct rollover to a charity. And in this situation where we just were talking about this person who's doing their RMD, if they rolled over $10,000, they would only have a tax liability of $255. So it would take years and years and tens and thousands of years for you to make up what you didn't take in tax savings if you had converted it to a Roth. So that's what's really important. And if you're wondering which to do, you can call us and we'll do the math for you.
Right. We'll figure it out, see what's the best thing. And the thing is, too, if you're converting over to a Roth, you got to have the tax money up front to pay.
That's right. When you listen to these people that say, we can fix it so you don't pay taxes in retirement, sure, you're going to pay it right now. And in my example here where you did the $10,000 qualified charitable deduction, it would take 658 years to, if you continuously did that, to offset what you would have paid in taxes had you not done a traditional 401k or IRA.
And then,
so if you're the only person contributing to your pension, you have to be very careful before you choose a Roth.
yeah, and then like Chris said, the conversion, even if you do that, it could make more of your Social Security tax
will.
and not
It'll make it more
mention
taxable.
your IRMA, which is your Medicare. So
Right.
that's a problem
But
too.
thank God it only affects 1 year though, right?
Yeah.
Right.
All right, I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. And we have Bonnie holding. Hi, Bonnie.
Yes, hello. I first of all, I want to praise you guys. Second of all, Christopher does my taxes. He did my taxes. I commend you highly.
Thank you.
I have to say that, first of all. Second, I just had a quick question. The government owed me, Christopher might know who I am. The government owed me 2 years of tax money. Finally, I got it. Last year, I had money coming back, but I owed them for a certain year, so they took last year and paid off whatever. But my question is, now they're saying that the interest that they paid me last year on whatever money it was, I'm gonna owe them on the money that they had to pay.
You mean
interest.
it's taxable is what you're saying?
It's taxable.
That's
right,
correct.
Yeah, right.
That's correct.
So,
Whenever you get interest on monies earned, that is taxable. So they're going to send you a 1099 form with the amount of interest that they had paid you, and that will go on your tax return in 2023.
right. Okay. All right. They didn't do that yet. So am I going to
No,
owe more
believe
money
me.
by waiting? I guess.
Believe me, they'll send it. When forms come out in January, you'll be getting it.
Okay. So I don't have to worry about any. It's not going to be any more money if I pay them earlier.
No, because you can't. That's money earned in 2023. It has to go on your 2023 tax return, which it doesn't
Okay.
happen until 2024.
Got it. All right. Well, I
Okay.
sure do appreciate it, and you
Thanks,
guys
Bonnie.
are wonderful.
Thanks, Bonnie. Have a
Bonnie.
good weekend.
Isn't that nice?
You too. Thank
And
you.
go Bills, go Bills. Yeah, that's wonderful. Yeah, so we're talking about 2023 taxes, which don't close until December 31st, and of which then they will send out the tax forms the booklets for the tax forms online, and then that's when you do your tax return in 2024.
Yeah, late last night I was doing 3 years of tax returns for somebody. And so somebody who's doing back tax returns, I don't think that's what Bonnie was doing, but this person didn't get any of their stimulus money. So don't forget, if you're doing back taxes, to put the stimulus money that you didn't get.
And don't forget, tax deadline for 2022 is October the 15th. And if you have multiple years, we'll do multiple years, right?
Yep, that's what I did last night for somebody. Yep, absolutely. And what year is dropping off pretty soon? 2022, 21, 20 is dropping off pretty soon. So if you have a refund, you got to file it by the deadline of the year coming up. Correct.
Yep, April 15th.
Yep.
Right.
Of the year
Okay.
coming up.
Again, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. All right, now, another thing that seniors need to think about is that their Social Security may be completely tax-free. So if your income, including half of your Social Security, exceeds $32,000, and you're filing a joint return, then everything over that $32,000 figure, half of it, up to 85%, could be taxable. But many people might have Social Security of let's say a couple $40,000, so $20,000 goes into the equation. And if you only have maybe a $10,000 distribution from an IRA, that means that 20 plus 10, it gets added together. That's 30,000. That's smaller than 32,000, which would mean none of your Social Security would be taxable. That would only leave the $10,000 IRA out there, and your standard deduction would be 30,700. So you wouldn't pay any taxes. But what would somebody do in this case if they had taken 10,000 out of their IRA and they have no taxable income? How could they play the bumper shots better on the pool table?
We'll get that after the news.
Oh, that's right. We got a break for the news. I'm Esther Galias. Talk to you on the other side. Hey, everybody. This is Auntie Esther, the tax lady. 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. Okay, so what would happen with my example of the 40,000 in Social Security, $10,000 in an IRA, married filing a joint return? They're not going to pay taxes. What can they do to maximize their withdrawal instead of just letting it sit there?
They got at least another 15,000
that they can take out of their IRA
Yep.
tax-free.
Right.
And so I don't think people understand the benefit of that. Once it's out of that IRA tax-free, you can just set it aside and put it in CDs, set it in investments, and then you don't have to worry about it later on.
Correct.
And that would mean your kids would inherit it tax-free. And there are people that are not paying taxes that have money in their IRAs, and if they increase their systematic withdrawal, they don't have to wait for the RMD, do they? Till they're 73.
No.
No.
Well, I mean, once you're 65, this $32,000 comes into effect. I mean, and you can take out more than you need because once it's out there, it doesn't have to be taxed again.
That's right. That's
And
right.
you win.
Yep.
It's something you should do. But I think, like you said, a lot of people aren't aware.
Right. That's right. And, when it comes to taxes, what you don't know really can hurt you.
Amen.
You want me to read this large text?
Well, no, I want to do the other thing. For seniors, many times are interested in gifting, right?
Correct.
Now, if you have an estate that's less than $12,292,000, then you will not pay any estate taxes on the federal government. You are allowed to give $17,000 per person per year, up to that, without filing a gift tax return. If you exceed that, then up to that $12,092,920,000 exclusion, you also wouldn't pay taxes. You would just have to do the gift tax return, reporting that you gave that. But a lot of people don't know that over and above that $17,000 per year per person, there is also unlimited college tuition that can be paid, and unlimited medical bills on behalf of another over the $17,000. So that's another thing that people need to know.
So when you gift money, repeat that. You can also gift if, for instance, if somebody's
Let's
in
say
need of
Grandma and Grandpa's got kids that are going to college, and so they grandkids. So they give $17,000. They want to start whittling down their estate. So they give $17,000 per person per year, and then the kids are going to Yale, and so they do another $75,000 to this child and $75,000 for that. That's even though it's over the $17,000, that's you can have unlimited amounts that you can give to benefit another taxpayer to pay for medical and education.
That's pretty cool. I
Yeah.
don't think many people are aware of that.
Right.
Yeah.
And then the other thing I wanted to talk about is that remember that your pension on New York State, if you're retired on a public pension, all of your pension is tax-free on New York State. If you're retired, if you're over the age of 59 and a half and you have taken up to anything over $20,000 in pension, that first $20,000 is tax-free on New York State on a non-public pension.
Right.
And if you've been taxing yourself on it, you have money coming back. Because they won't tell you that you're paying taxes that you should have.
No, they
They'll
won't.
just write you a letter if you shouldn't have taken the exclusion, right?
That's right.
Okay, so we got the long text.
Yes, it says, I have a question about how the purchase and the sale of a home in the same tax year will affect our taxes. My wife and I bought a house and we closed September 15th. And our house that we're selling goes on the market next week. And we hope to have it sold before the end of the year. My wife owned the house that's being sold for about 25 years. There's no mortgage on that house. And we also took out a HELOC to fund the new house.
Okay, so the sale of the old house is the sale of the old house. And I don't know what her gain is going to be, but if it's less than $500,000, it's going to be completely tax-free since she lived there more than 2 out of the last 5 years. Then they bought the new house, and the new house, you don't have to deal with that until you sell it. And so it's 2 separate transactions. The purchase has nothing to do with the sale.
Correct.
That's it?
Yeah. I mean, obviously, if you're an itemizer, because if you're a heavy charity or because your property taxes are limited, you could look at the closing statements from both and see if there's a little bit from each closing statement to add to your property taxes and your mortgage interest.
Right, if you're an itemizer.
Correct.
Okay, another thing I wanted to talk to seniors about is another tool in your toolbox is a reverse mortgage. Now, a friend of mine's dad just passed away a couple days ago, and the mother, she's going to lose her Social Security benefits, and he had the stepped-up pension, but it reduces to 75% of what he would have gotten. So now she's really tight, and she's got a mortgage on her house. So she was all upset, and I was talking to her, and she said, I really want to stay in my house, but I can't afford to stay in my house because my house payments is like $1,000 a month, and with Social Security and little pension, I've got about $1,800 a month, and I don't know what to do. And so I said to her, have you considered a reverse mortgage? Now, reverse mortgages cost they're going to charge her an interest, but they will pay off her first mortgage, so she has no mortgage anymore. And it is true that they're going to go into the equity of the house, of which she has about $250,000 in equity. But like I was telling her, I said, you may do a reverse mortgage for 3 years, then sell the house, and then whatever you owe them, that's what they're going to take off the top on the sale, but the rest of it's going to be your money. Or she might want to just live in that house for another 20 years until God takes her home, and maybe the equity is going to be eaten up more and more. Or if it even went upside down, it's all tax-free, and it's a tool that she can have, and because she was so frantic that she had to get out of the house because she couldn't afford it. and the reverse mortgage wasn't doing very well when interest rates were 1% and 2%, because they weren't making any money. Well, now that's 7%. And so in this situation, they'll pay off her first mortgage. She'll have no payments anymore. All she has to do is maintain it and pay the property taxes and the insurance, and she's good to go.
Right.
So it's something to look at.
Yeah.
Yeah, I
And
mean,
Maybe not for you, but it might be for someone you know, or it might be for you.
right, especially if you don't have children. I mean, why not use all the money in your house that you can to stay living where where you're comfortable?
If that's what you want to do. Obviously, because then she said, well, I don't even have the money to move into a nursing home. I mean, she's just not, she doesn't have the income. But here she's sitting on $250,000 of equity.
That's right.
So, and she doesn't have to make that mortgage payment anymore. So reverse mortgage is something, again, and it's strictly for seniors.
Yeah, and not to mention if she goes to get another mortgage, the interest rates are so high right now. So.
Yeah, well, why would she get a mortgage? She
Right.
could do, on the reverse mortgage, you don't even, your credit has nothing to do
Yep.
with it either.
Yep.
You just qualify. That's it. And she's 80.
Yep.
So,
Good plan.
okay. What do we got there, Tim?
Afternoon, family. I am 74 years old. I collect Social Security and a military disability pension. I had to stop working 20 years ago due to my disability. My Social Security is lower because I stopped working so young. Can I add to my Social Security to increase the amount of my wife if I passed before her? God's blessing for each of you. Dan. Hi, Dan.
I
So-
guess I don't understand the question. Do
he
you
wants to
understand
know
it?
if he can probably pay into Social Security to increase it, so when he passes, his wife gets a larger amount than.
Well, I mean, if he goes back to work and he's paying into Social,
Right.
but he would never pay into Social Security, 100%
Just open up
and
your
get back a little bit.
Just open your checkbook and do that. It wouldn't work
But
like that.
but that leads me into this next part. If you should go back to work, right?
But right, to finish off Dan's text
oh,
really
sorry.
quickly, I just want to say to Dan, unfortunately, the only way is to go back to
to
work,
work.
Right.
for you. And I guess his wife could go back to work too and try to increase her Social Security to make it higher payout than his. Are the only
Well,
two-
and the other thing is you might be somebody that hasn't worked 40 quarters. And you're you might be 5 or 6 quarters off from being able to collect anything. Go back to work and get your 5 quarters in.
Yeah, absolutely.
I
Yeah,
mean,
yes.
you need 40 quarters to collect.
Yeah.
And so if you are somebody that maybe you're a minister and you've taken a vow of poverty and you're out of Social Security and now you're retired and you sure could use the money, you can go back to work and get the rest of work until you get your 40 quarters.
That's right.
Maybe you only have 5 or 6 quarters to go.
Yep.
So greet her at Walmart,
There's so many options right now.
But so
And
going
maybe-
back to work though, if you go back to work, regardless of your age, and you don't have a qualified pension plan, or you have one that's your income is lower, you can still put money up to $7,500 if you're a senior. Each one of you, if your wages are at least $7,500, you can put $7,500 into an IRA. If you make $15,000 and you're married, you can do $15,000, $7,500 for your spouse and $75,000 for you, even though you're 80 or 90 or 100, whatever it is,
Right.
as long as
right.
you're still working.
Yes.
Yes?
Yep.
Okay. All right. What do we got here?
Got another text. Hello, fellow Bills fans. Can you confirm the factor that you divide by this year for your RMD?
27.4.
Well, depends on your age.
Oh, you're right, Chris. I jumped right in there. Right. Assuming you're 73.
Right. So if you want to give us a call on Monday, we can ask you more questions and tell you the exact divisor rate.
but-
Right. Because it changes every year. Every year past 73, they think you're going to live shorter. And
But-
so the divisor gets bigger.
At the age of 73, as Esther was saying, that's the age you have to start doing your RMDs. And so if you are 73, it's 27 point what, Esther?
Four.
27.4.
Right.
And that's a divisory rate. It's not a percentage. A lot of people
Right.
get confused.
So
on
you
it.
take your
Amount.
your amount that it was worth, your 401k or IRA on 12/31 of 2022.
Closing balance. Yep.
Right, and you divide that by 27.4.
Yes.
Okay. All right, we're going to take a short break. I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us, 716-8030930.
The bills make me wanna shout. Kick your heels up and shout. Throw your hands up and shout. Throw your head back and shout. Come on now, the bills are making
Boy, oh
happen.
boy, oh boy, I'm going to be praying like crazy tomorrow. You know, but when I pray for the Bills, I think, gee, what if somebody on the other side's praying for the Dolphins? Do we cancel each other's prayers out? Anyway.
Dan,
All right,
Dan-
we're talking about seniors. Yes, ma'am.
Oh, geez, I bet sneeze.
Dan texted back in. He's 100% disabled, so he can't work.
How about his
anymore.
wife?
Right. That's right. If your wife worked, Dan, she might be able to get a
Or
higher
if she
social.
doesn't have her 40 quarters.
Right.
Right, and if she, if she can go get her 40 quarters, then she'll get something, and really this whole thing. Sometimes you talk yourself out of it. Give us a call. We'll brainstorm with you to figure out is there a way around it. Don't just give up the ship, so
No.
to speak.
No,
Right.
right.
Some people, what you don't know, like you've always said, doesn't hurt you. Like a couple weeks ago, Tiff's client, her ex-husband passed away, and she didn't know she could collect off of his Social Security.
Right.
There's a lot of different things out there that can help
Yeah,
people.
so if you are divorced and your former spouse you were married to at least for 10 years and they pass away, you can collect off of their Social Security. And you can say, well, I didn't know that. Well, now you do.
And the sad
Right?
thing is that Social Security will not call you and let you know. It's just the facts.
Okay, and the other thing is we were talking about putting money into the IRA if you're a senior and you're working. And the other thing you would qualify them for is a pension savers credit. So that means you can even take more out of your 401k free. And this year's pension savers credit limit for married couples go up to $73,000, and for single people it's $51,000. So a lot of people could get that credit for putting money away into their IRA,
That's right.
and that means you can take more money out of your pension plan, right?
That's right.
Okay, which seems redundant, doesn't it? Like they're going to you got an RMD, you got to take money out, but then you can do the IRA and put money in, and they're going to give you a credit for putting money in the IRA when they force you to take it out. But that's the way it works.
Yeah.
Right?
Sad, but that's it. That's the facts.
Okay. All right. And then other things I thought was important for seniors to know. Unfortunately, as we get older, the talk around the dinner table many times is about how do you feel? What medication are you on? And medical is a big tax deduction if you're an itemizer, and it has to exceed 7.5% of your adjusted gross income. And this includes your Medicare premiums, long-term care insurance, health insurance premiums, hearing aids, dentures, the batteries for your hearing aids, glasses, hospital, doctors, nurses, chiropractors, seeing eye dogs, medical appliances, and on and on. If it cured a specific medical problem, then it is qualified for a medical deduction, but it's reduced by 7.5% of your adjusted gross income.
Yeah, and if you were in a complete care nursing home and they charge the assessment tax or the bed tax, that's
good point. I forgot that, Tiff.
That's a refundable credit on New York State.
Okay, explain how it all works.
Sure. New York State charges, I believe it's now 6.75% bed tax. Well, they keep 0.75%, and they'll give you back the other 6% as long as you file that form. If you don't file the 258,
258. It's a 258.
Yep.
Yeah.
Then they keep it all. And the sad part is nursing homes don't tell people, hey, make sure you file this form, get your money back.
So remember, it's just for private pay patients. Right. So if, let's say that you spend 6 months private pay waiting to go on Medicaid, but you've been paying your for your spouse or your mother or dad or whatever to the nursing home, they've been charging you 6.75% bed tax. 6% of that comes back. Now that's a lot of money. So if you're averaging $15,000 a month, that's $90,000 that you paid to the nursing home, and so you're going to get back $5,400 if you file the form IT-258.
That's right.
But if you don't file the form, then you don't get the money. They keep it.
Yeah, and then don't forget that $15,000 a month. If you're itemizing your medical, you can also add that to your
That's exactly right.
medical expenses as an
And
itemizer.
and think about this. Many people are taking money out of a taxable event like an IRA or a 401k
Frank.
to pay the nursing home. On the opposite side as an itemized deduction, that's a medical expense. So you don't just pay the taxes. Make sure you itemize,
And
because that helps.
Don't forget, we're talking nursing home. The nursing home insurance is a medical deduction on the federal, but it's a credit on New York State that's a carry forward credit. So you may not need it now, but eventually, you know, you hit the lottery, you hit the casino.
Or you're stuck taking a lot of money out of your pension plan.
Yep, you sell that rental property that you had all those years. It could come into play and save you lots of money.
Right, absolutely. So these are just things that we'll talk about on the road to retirement. Remember that seminar is going off November the 11th at the Financial Guys building, right?
Right. Yep.
So if you want to come, there's no charge, and it's like a taste of retirement. All the speakers get up and give you like a 15-minute, and actually it's not even 15
5
minutes,
minutes.
like 5 minutes about what they specialize in, and you can talk to them absolutely no obligation about your questions. And many people just walk out and say, that was just great. I don't need to go see anybody now, right?
Correct.
That's right.
All right, we got some calls.
We got Kathy.
Hi, Kathy. How can we help you?
Hello. Well, I've been listening, and I'm not really abreast of all the things you're talking about, but I heard you mention RMD or RND. What is that?
That's the required minimum distribution for people. The federal government requires you start taking money out of your pension plans and IRAs once you reach age 73. If you
I'm
don't,
in the New York State Civil Service pension plan, and I'm still working.
Okay, but you're not 73, are you?
I'm 74.
Okay, so do you, as long as you're working, you are exempt from taking the money out of your pension, but you still have to take money out of your IRAs and 401k plans if you have it. So do you have IRAs?
No, I don't have either of those. But when you say if they tell me to take money out, what am I going to do with the money? Where do they want me to put it?
You can put it wherever you want. It's your money. But you have to take it.
In other words, there's a maximum. There's a maximum that you're allowed to have under New York State.
Here's the deal. The federal government's waited all this time for Kathy to get old enough to start taking money out of her pension plan, and just because she doesn't need it, they need the money. So they're forcing you to take it out so it's taxable. That's why it's a required minimum distribution. They want your money.
But the good news is for Kathy, she's still working, so she doesn't have to.
Right, but for other people, this is why they do it. So, and if failure to do it used to be 50% of the amount of money you didn't take out. Now it's 25%. And if you take it out right away, after you find out that you should have taken it out, they're going to reduce the penalty further. But the required minimum distribution is because they want your tax dollars.
Does it matter how much money, when I do retire, does it matter how much money I have in there? If it's under
are
a
you
certain
talking
amount,
your
they won't tell me this?
403B?
I really just call it my New York State. See, I put in, like, say, $9 every 2 weeks, and they put in $9, New York State. It's the regular retirement plan, retirement system, New York State.
All right, on New York State, if it's your New York State retirement, you will pay zero taxes to New York State on that. Okay, because you're in a public pension plan. But on the federal, once you stop working, you have to start withdrawing.
So it's a federal thing that's mandating
Well,
this RMD.
because you happen to be really lucky that you're a New York State retiree. The rest of us aren't, and we all have to pay taxes to New York State if it exceeds $20,000. You are a blessed lady.
So as long as it doesn't exceed $20,000 before I retire, I'm not going to hear from them.
No,
I will hear from them.
The federal requires it. All right, once you retire, the state of New York is going to let you get away tax-free.
Because it's from New York State. Your money's tax-free
Gotcha.
on New York State.
Gotcha, but the feds are the ones that will make me do this.
That's right, because they want your money, Kathy.
And I will
They
get a
want the
letter
tax.
from them.
Oh, no, you won't get a
telling
letter.
me?
No, you
My
won't get a letter.
tax
You're going to get a
bill is
1099-R form once you start withdrawing.
When I start withdrawing, when I start drawing on the pension, you're saying?
That's correct. Once you're not working anymore.
Gotcha. And only if it's exceeding 20,000, then I'm going to wind up getting little by little?
All pensions are fully taxable, subject
Fed.
to the limitations of the standard deduction and other deductions, okay, on the federal, okay? On the state of New York, your New York State public pension is fully tax-free. If you're retired on a non-public pension, then the first $20,000 is tax-free once you exceed age 59 and a half.
It's very
Incredible.
confusing.
Thank you, Esther.
You're
Goulias.
welcome, dear.
The best one in town. All
Thank
right,
you.
Thank you. Bye-bye.
All right, so
It's
where
so
were we?
It's so funny. I was talking to my daughter, and she said, "I'm convinced that that magnet that old Nene had on her refrigerator was right. If you rest, you rust." So I'm glad Kathy's still working. Hallelujah to her. You know.
Right. So things I want you to think about. Have you made a will? If you're a senior, just because you make a will doesn't mean you're going to die, but you really should have a will.
That's
right?
Yep.
Maybe you need a trust. You certainly need a healthcare proxy. And if you're somebody that's interested in learning about retirement and like free things we're putting on the road to retirement, you can go to our website and register. You can call us. You can also call the financial guys, right, guys?
Right, 633-1515.
Okay, till next week, after the Bills are victorious over the Fish, right?
Yep.
I'm Esther Goulias, the tax lady from EG Tax, with Tiffany Fabian, Christopher Fabian. Thanks for listening. And if you need us during the week, go to our website, egtax.com. Thanks for listening. Bye-bye.